Bank of America this week reported better than expected interest income for the third quarter yesterday, better than expected earnings. As you can see, the stock this morning at $27.44. The company reporting better than expected earnings. And joining me right now is the chairman and CEO of Bank of America, Brian Moynihan. Brian, it's great to see you. Thanks so much for joining us this morning. What drove the quarter, and can you assess the macro story for us?
Well, Maria, first I want to congratulate you on 30 years on the air. It's a great accomplishment, especially in this day and age. So congratulations.
Thank you so much.
When you think about our quarter, and you're welcome. When you think about our quarter, it's our team that did the job, and they did a great job producing profit growth year over year of 10%, but producing a 15% return on tangible common equity, revenue growth, great expense management, bringing it down each quarter, as we said. And importantly, we can see a path forward. We're now seeing that interest income, which is one of our major drivers of revenue, flatten out at a level and then going to grow from there based on what we see in the forward curve of interest rates. And so we feel good about it. It was good trading. It was good lending, good deposits, and everything continues to work. $7.8 billion in net income.
Yeah, and I mean, I think that, you know, the bears out there on banks in general are worried about a large bond book. I want to get your take on that. Obviously, you've got incredible deposits, and that's a major positive there. But the presentation that you've been making on the bond book, tell me about that, and tell me about the unrealized losses that some investors are worried about.
Well, 2 years ago, we had to make a decision to start to get value out of the deposits that our great customers leave with us. So we have $1.9 trillion of deposits. Back then, we had $2.1 trillion. We had $1 trillion loans. Back then, we still have about $1 trillion in loans. And so when it was clear those deposits were staying with us, we had to put it to work, and we did. And we did that in the summer of 21, and it's just been running off and matching off. We have $1 trillion to invest every day, near $900 billion to $1 trillion to invest. Half of it's shorts, half of it's long. And that stability and that earnings stream provided great earnings over the last couple of years and provide stability going forward as we do it. As that bond portfolio matures, we just take that money and put it in short term. And so that's how we got to $14.5 billion of NII this quarter, more than the street predicted us, about 14.2. That's why we feel good about the $14 billion we'll have in the fourth quarter and how we've seen the trough. It's that stability produced by that great deposit base.
That's a great analysis. The 10-year Treasury yield jumped to over 4.8% yesterday, Brian. As you know, the Wall Street Journal is writing that consumers are, quote, on a spending binge despite high interest rates and elevated inflation. You've talked about a very strong consumer in the past, but you've seen modest slowing of that spending. Tell me about the consumer today and what the impact has been of these higher interest rates.
Well, clearly, the higher interest rates affect the most rate-sensitive activities. So homes, and you saw mortgage applications were low today. Just because a higher interest rate makes everybody step back and adjust. Car purchases, same thing, and those impacts go through relatively quickly. And then people are forgetting on the commercial side, there's a huge impact of higher rates in terms of people's willingness to borrow. And so lending conditions are tight, and that's what the Fed wanted to achieve. When you look at the consumer side, from spending, 2022 over 2021 across the Bank of America consumer base, you'd have seen 9.5% to 10% of growth in that spending year over year. In the first part of this year, first part of 23 over the first part of 22, you would similarly see 9%. What you're now seeing is 4 to 4.5% in the month of September for the quarter, so far the month of October. What does that mean? That means that the rate of spending across $4 trillion plus that our consumers spend every year through their accounts, whether it's credit cards, whether it's cash, whether it's checks written, that $4 trillion is growing at 4% now. And if you look back and say, what does that mean in historical context? That's more consistent with a low inflation, low growth economy. So the point is that all the impacts of everything going on have led the consumer to slow down their activity. Well, they'll be bouncing around in retail sales. This is across all the things they do with their money. And we feel we've been watching this data for 30 years, and it generally leads the other people's data in that it's real time. It's across a huge base of customers. It's not based on surveys and other thoughts. It's based on actual movement. And that at 4% says the Fed has gotten the U.S. consumers slowed down, which was the major challenge they had to get the economy back in line with inflation and growth.
What about small business, Brian? You're obviously a great destination for so many small and mid-cap businesses, and we've been talking about the impact of these rates on their interest payments, which, of course, has gone up in some cases. How would you characterize small business right now in terms of this tight credit environment?
So I think if you think about the different types of businesses, we have small businesses, say under $3 or $4 million in revenue companies. We have sort of medium-sized businesses that go up to $50 million and $50 million to $2 billion plus in revenue. So we go after business in 3 or 4 pieces. You had our colleague Sharon Miller on last week. The small business borrowing is still pretty robust. We had $2.8 billion originations in the quarter. We have a $40+ billion loan portfolio and loans of under $1 million to small and medium-sized businesses. We're the largest in that space. So we feel pretty good about that. Their temperature, for lack of a better term, is mitigated by the worries about inflation, the worries about getting teammates to work for them, and also, frankly, the impact of higher rates. Interestingly, when you go into larger companies, you've seen them not use their lines of credit. They've dropped the line usage back down. That is an indicator the cost of credit has gone up, so they're much more careful about how they use it. Yeah. That conditions of lending are tightening, as you said, and that's clearly happened. And again, now it will lead to a slowdown economy. And our teammates have it predicted to slow down and trough out in the middle of next year at just barely growing at half a percent in the second, third quarter, and then working its way out from there.
Yeah. I want to talk about the regulatory environment, but before we get there, let me just get your take on deposit cost, because I know you've been de-risking this balance sheet now for, what, 15 years or so, and it has been obviously proven really effective for you in managing times that are volatile. Borrowings offset higher deposit costs in the quarter, but people are worried about the pressure on those deposit costs because maybe the Federal Reserve is not done yet. Maybe rates even go higher than that. What can you tell us?
Well, our all-in deposit cost is 1.5% against a Fed funds rate, a 5% plus. So think about that spread. And what we're saying to people is the value in our deposit franchise at $1.9 trillion comes from the fact it's core transactional accounts for our customers, be they businesses, wealthy Americans, or general Americans. And if you look at it, you're seeing growth in the wealth management space now, or stability and slight growth. You're seeing growth now. 6 quarters ago, we hit the low point in the business side, in the global banking side, and that's now growing. The consumer side is still drifting down a little bit, but the thing that drives the consumer value of our deposit franchise is the $500 billion of low interest and no interest checking. And that's because we have 37 million checking accounts, which have grown, pre-pandemic to now, have grown by 3 or 4 million checking accounts. They're all great core customers, and they're wonderful, and the team does a great job serving them. And that's what provides the grist for the real profitability. So 150 basis points all in for $1.9 trillion is up a lot from where it was a couple of years ago. Yeah. But on the other hand, the floating rate side of our balance sheet and the loans are up much more.
What about the ramifications of what's going on in terms of the regulatory proposals? Obviously, the proposed capital rules for banks. I know you believe it's going to hurt your ability to lend and make the industry less competitive, given what's coming out of Washington. You've also got new rules on fees, how much you can charge in terms of credit cards. You do have some analysts lowering estimates in terms of the fee revenue this morning. Talk about the regulatory environment right now and what's new there in terms of challenges for the entire industry.
Well, the big discussion now is the new capital rules have been proposed. There's sort of what they call Basel III endgame. There's a request for proposal out. There's comments due at the end of November. You'll see a lot of comments by our industry, by our company, and by many others, basically saying, let's think through whether this is a wise set of decisions or not. You're seeing a lot of discussion among the governors of the Federal Reserve, a lot of discussion in Congress and around saying, should we do this? Is it the right thing to do? Is it anti-competitive for American businesses, small businesses, in that it's going to provide a higher cost of borrowing for them versus foreign businesses, which are competing in the global supply chain? What it means to us is basically it will say that you need $195 billion of capital to support the inflation in our risk-weighted assets. So we have $1.6 trillion in risk-weighted assets under the new rules. As proposed, it'd be $1.95 trillion, and that requires $195 billion of capital. We have $194 billion of capital, regulatory capital in the company now. So this is not a big issue. But on the other hand, the question that does is takes $300 billion of lending capacity we could have to support American businesses and help them grow, takes it out of the system. For the same risk we had yesterday, we have to have $30 billion more capital. We're saying that may not be a great thing to do any time, and clearly today, to slow down the ability of the banking system to support small and medium-sized businesses in the United States.
Yeah, and I'm glad you mentioned the international component here, because you've got major banks that you're competing with every single day that are foreign banks, and they're not faced with the same capital rules and the same, constraints that the U.S. banking system is. So it's a fair point. Brian, before you go, real quick on the macro story here and what you're seeing at B of A in terms of this slowdown because of higher interest rates. There's a lot of people expecting that the Federal Reserve maybe is done at this point because the market has done the work for it. And we're going into the holiday period with some expectations that things are going to slow down, as you just said. How severe will that slowdown be in the year ahead?
Well, we have a great research team run by Candace Browning, and they basically, over the last year, have been pushing out their view of the trough in the economy. A year ago, when you and I would be talking, it was going to be at the middle of 23, then it was the end of 23. But now they've settled in that basically the economy slows down in the middle of 24 to about 0.5% annualized growth for the second and third quarter, and then works its way back out. It takes and the Fed will start cutting rates, they believe, in the middle of next year to the latter half of next year. So that's the basic thing. What would be called a soft landing. Now, the risk to that is the geopolitical risk, as you mentioned. The risk to that is if the Fed tightening goes too far and the conditions around go too far. But the reality is that that's their current view, and it's supported by what they see in the underlying consumer activity that they get a view to, not only in our company, but in other companies.
Yeah, for sure. Brian, I've been watching your leadership over these 30 years, and I want to congratulate you for turning this company around since the financial crisis. It's good to talk with you this morning, sir. Thank you.
Congratulations, Maria, on your 30 years.
All right, we'll see you soon.